I want to come back to the sort of due diligence piece of it when you do your work to figure out what's, the company and whether it's the right fit for you. You did mention valuation, and really important point that valuations aren't apples to apples unless structure is consistent between the two. So it's a really important thing to look at. But you've invested in a lot of SaaS companies. Let's talk about SaaS valuation in particular. What are some of the, all companies aren't created equal. I won't ask you to just kind of say what's a SaaS company worth, but I think what would be helpful for founders is, how do you think about what's my company worth? In other words, what are some of the metrics that you as an investor are going to look at to say, this is a really high quality, this revenue is of high quality. We want to pay a higher multiple for this. What are some of the things, beneath just the revenue number that you want to see to sort of put that value on the company?
Yeah, so I would say, like, real simply, right? And this is, again, a misnomer, but like, a lot of times people look at your revenue and put a multiple on it. Maybe it's, 8, 10, 12, 15 order of magnitude, something like that, right? And that really starts to happen when you're kind of a million or two of revenue annually and up. Usually it's kind of on the annual recurring revenue. Under that, it's a little more kind of market driven. And I think the rough rule of thumbs is like, for every round of venture capital you raise, usually you're selling somewhere between 10 and 25% of the company. Mm-hmm. And so in a lot of ways, it's almost like the round size is this to get to this far, kind of all back solves in a weird way to be remarkably kind of consistent. But I think in terms of what drives higher valuations, right, and higher multiples, there's a few things, right? I think at the earlier stages, one really important thing is, like, do all your customers look the same? Are you truly a scalable product company that has, a big market, right? And within that big market, you've sold to 5, 10, 15, 20 companies that all are repeatable, similar use case, and you've kind of found a nail on a hammer you can just kind of keep hammering away at. Mm-hmm. Have you retained them, right? So do your customers retain, and hopefully not just retain, but do they hopefully grow over time as you give them more value, build more product functionality? And that kind of leads to what's called net revenue retention, which is a metric. And I think, top tier companies are 120 or 130% a year and up, where existing customers are growing 20 to 30% every year on top of, new customers. And then just kind of growth rate in general. And really, like, VCs are typically looking for companies that are, growing 70 to 100% or more every year. So kind of almost or more than doubling every year. And then I'd say the last thing that people are really paying attention to kind of burn multiples, right? And so how fast are you burning relative to your growth? There's burn multiples, rule of 40s. It kind of all yields the same result, where, like, if you're growing really, really, really fast, you can burn more. But like, you don't want to burn like unlimited amounts. And there's a relationship between the two. Candidly got a little bit untethered, I think, when firms were looking at companies a couple of years ago, that now they're really looking at. And so it's the efficiency of your growth is real important. And I'd say the last thing is kind of like sometimes deep technical moats. And so, like, companies that, are workflow software, which can be very valuable, right? But like, they may be valued differently than something that's a system of record where customers are storing lots of data, or things that have like deep, hard technical innovations that maybe took years of PhDs and a lot more capital to kind of build out the product than a lot of other companies. And so those sometimes might get valuations that are a little less tethered to revenue, but when they get product market fit, they can grow really fast without a lot of competition.
Interesting. Yeah. Okay. So deep tech there. The use case.
That's a lot of the AI stuff right now.
Yeah, sure. Yeah. Makes sense. The use case one is pretty interesting to me. So for a relatively early stage company, it actually can be a little bit of a red flag if you see across their customer base that they're kind of using it in different ways, or the customers don't look all that much like one another, which is a little bit counterintuitive, because like, oh, we have all different kinds of companies who like our product. That feels like a good thing. But what you really like to see is a set of companies that look similar. And then you want to look out into the world and say, oh, there are a lot more companies like that we can go knock off, right?
I think that's like at a high level, yeah. And I think, like, if you're a horizontal platform, like a, database or a piece of DevOps infrastructure, I'm not saying like they need to all be the same type of company, but like ideally they're using it for a similar use case, like to store a certain type of information or otherwise, right? And so it's really like, is there repeatability to the sales cycle? And I think to your point on the flag, if they're customers that are all using like things in different ways, a lot of times that might mean there's really 10 different products that have all been customized, and it's more of a services business versus a product business, which like can still be a great company, but it doesn't typically fit the venture model of build a product that can be sold scalably to a whole bunch of customers.
Yeah, that's a really good insight.